You're sitting in seat 23A when suddenly, as you reach for your favorite snack, you notice something strange. The price tag is higher than usual. Last week, it was $1.50. Now, it's $1.75. You wonder, why is this happening? It's not just a one-off, either. This has been going on for months. And here's the surprising part. You're not alone. This happens to everyone who buys snacks at the airport or any place with a bit of inflation. Inflation isn't some mysterious force. It's actually pretty simple once we peel back its layers. Inflation is more than just prices going up. It's about your money gradually buying less over time. Imagine you had $1, and every year, that dollar could only buy 95 cents worth of the same snack you love. That's inflation in action. Let's break this down further. When we say purchasing power, we're talking about how much stuff one unit of money can buy. Inflation means your dollar is slowly losing its purchasing power, like a sponge soaking up water and shrinking bit by bit. And here's the surprising part. Inflation isn't just something that happens to prices. It's actually a measure of how much your savings grow in real terms compared to price increases. If prices are going up faster than the interest you get on your savings, then your money is losing value. Think about it this way. If you have $100 in cash and the inflation rate is 3% per year, after 1 year, that same snack that cost $2 would now cost $2.06. But let's say you've put your $100 in savings account with an interest rate of only 1%. At the end of the year, you'd have $101. But because prices went up by 3%, the real value of that extra dollar is less than what you lost to inflation. Now, here's another way to think about it. If you're saving for a big purchase like a new car or planning your retirement savings, and inflation is eating away at the buying power of your money, then those dollars won't stretch as far when you need them. It's like trying to fill up a gas tank with water instead of gasoline. Okay, so you're sitting in seat 23 when suddenly it dawns on you. Okay, you're not really in an airplane, but imagine if you were. You've just landed, and you see everyone scrambling to get their luggage. But wait a second. There are more people getting off the plane than there usually are. That's because inflation is like one of those situations where suddenly more money is chasing the same amount of goods. Let's break this down with a simple analogy. Picture yourself in a bustling marketplace. You have a certain number of apples sitting on stands, and you decided to sell them for $1 each. Suddenly, people start bringing twice as much money into the market. Let's say it becomes $2 per apple instead. Now, every person is trying to buy those same apples, but there are too many dollars chasing after just enough apples. This is exactly what happens in an economy during inflation. More money, like your extra dollars, gets pumped into the system, but the total amount of goods and services stays about the same, like the fixed number of apples. As a result, each piece of money can buy less than it used to. Hence why we say that money's purchasing power has eroded. And here's the surprising part. This isn't just about price tags going up. It's also about how savings get eaten away. If you had $100 in your piggy bank a year ago, and now due to inflation, those same apples cost twice as much, suddenly your $100 won't buy as many apples as it used to. Your money has lost value because there's more of it chasing the same amount of stuff. So, remember, inflation is like that race where you have an increasing number of runners, but only one finish line. The extra runners, money, make each step, purchasing power, a bit harder to reach. You've saved up some money in your piggy bank, and you're happy about it, like putting a jar full of quarters under your mattress. But have you ever wondered what happens to those quarters over time? They might look the same, but their buying power could change. Imagine that each quarter you used to buy a big scoop of ice cream. Now let's say inflation is kicking in and things are getting more expensive every month. What starts as a fun treat for 25 cents could suddenly become a luxury item priced at $1.50 or even $2. So here's the surprising part. Your jar of quarters, while still the same number, can now only buy half the ice cream scoops it used to. That means your savings are losing value because you're not able to get as many goods and services with them. It's like if you put away a jar of 100 coins last year, but this year that same jar can't buy you nearly as much candy. All right, so you've got a good grasp on how inflation can eat away at your savings. Now let's dive into why central banks are always on the lookout for that pesky inflation and what they do about it. Imagine you're in seat 23A of a bustling airport terminal. You see all these travelers rushing around, checking their watches and looking stressed. That scene is not too different from what's happening in an economy with high inflation. Everyone's feeling the pressure, but central banks are like those friendly TSA agents who want to calm things down. Central banks have one powerful tool: adjusting interest rates. Think of them as the traffic controllers for money. When they notice that inflation is running a bit too fast, let's say your savings account has been losing value quicker than expected, they will step in and raise their interest rate lever, like adding more traffic lights at key intersections. Here's how it works. When interest rates go up, saving becomes a much more attractive option. It's like suddenly the snack stand is offering free candy, but only to those who are willing to wait for 15 minutes. This means people and businesses might hold on to their money longer, spending less on things like groceries or travel. And here's the surprising part. When fewer dollars are circulating in the economy, prices tend to come down a bit. It's like if everyone was only buying 1/3 of the snacks they used to. Suddenly, the candy machine doesn't need to make as many candies each day because they're not selling out quite so quickly. It's not always easy. Raising interest rates can slow down economic growth and job creation, but central banks are willing to do it if inflation gets too high. They want to keep everything running smoothly, like that airport terminal you were thinking about earlier: calm, organized, and stress-free. So next time you see those news headlines about central banks raising rates, remember, they're just trying to balance the scales and make sure your savings stay healthy. All right, so you're sitting in seat 23A when the economy suddenly takes a turn. The news tells you that inflation has risen to 4%. You're worried about your savings. What can you do? First, let's think of it this way. Saving money is like planting a garden in dry soil. Over time, the soil might erode, but if you plant seeds that grow, they could flourish and even protect against the sun's harsh rays. Now, imagine your savings as those seeds. If inflation is 4%, your money loses some of its value every year. So, just like a garden needs different care to thrive, your savings need strategies to keep growing. One strategy is to invest in assets that can grow faster than inflation. Think of it this way. If the economy is like a race, you want to be on a bicycle instead of walking. A bicycle, an investment, will cover more distance in the same amount of time compared to just walking, saving. Let's break it down. 1. Bonds. These are like renting out a spare room. You're lending money to someone for a set period, and they pay you interest. But if inflation rises, your interest might not keep up. 2. Stocks. Owning stocks is more like owning a company that can produce more goods or services as prices rise. If the company grows, so does its value. 3. Real estate. This is property, like owning land on which you can grow fruits and vegetables. Real estate often increases in value over time, especially when inflation hits. 4. Commodities. Metals, oil, and other raw materials will likely increase in price if the economy heats up, making them good hedges against inflation. And here's the surprising part. By diversifying your investments across these different assets, you're like planting a mix of flowers, vegetables, and herbs in your garden. If one type of plant doesn't do well, another might thrive, keeping your investment healthy even as inflation takes its toll on your savings. So, you can protect your money by choosing the right seeds to plant. But remember, just like gardening, it's a long-term commitment and requires care and attention.